Can you see me?
Yes, I can.
Okay.
Hey, come on in. See, Lewis, we got a front row seat for you. That's, you know, if there's anything good about webinars, is everyone gets a front row seat. We got a great lineup today to talk about, you know, banks are restricting access to capital. It's going to get real tight here in the next couple quarters. All right, see people coming in. We'll give just a minute to get settled, and then we're going to launch the show. Yep, Bruce. See some people I recognize. Grady Davis, welcome to the event. You know, got some new faces. I don't know if you guys, you know, Dan, Logan, I don't know if you recognize some of our participants, but hey, as you come in the chat box, if you put, you know, the city that you're located, that'll help us know who's in the room and perhaps come up with examples that are really relevant to you, what's going on in your neighborhood. Yep, Chicago, my favorite city. San Diego, very good, someplace I need to be. Nice, we got it. Atlanta, Houston. Yep, Mary, welcome to our webinar here, River Falls. We got a good group of people. You know, CEOs, we need access to money. I'm gonna give it just a minute here, and then we're gonna launch the show. Yeah, Maryland. I'm in Bethesda, Maryland, right outside of DC, so I recognize you, Greg, quite well. We spoke this morning. Excellent. Okay. Rings Nova, good, very good. So, okay, we're at time. I'm going to launch. Dan and team, you guys ready?
Yes, sir.
Yeah.
Rock and roll. So just to introduce myself, I'm going to be the master of ceremonies. My name is Kirk. I'm the CEO of Foresight CFO, and basically we've got 32 CFOs on 3 different continents doing the kind of work that we're going to talk about today. How do you grow your business with clarity and make sure you have access to capital that really really works for you. So in addition, I teach the same topic, financial management, to Georgetown students as a guest lecturer, but a lecturer. So I'm really excited about our lineup with Infinity, which is a firm out of Dallas. So Dan, can you introduce?
Yes.
yourself?
Thank you, Kirk. Thank you. I'm Dan Flick. I'm the managing partner and founder for Infinity Financial Group. Had the company for 13 years now. We do 2 things. We do corporate finance and we do M&A. And in that realm right now, and why we're all meeting today, is everybody in our group, except Logan is our young guy, we've been through multiple black swan events in our careers. We know what's coming, why it's coming, and how it works, and what to do. And on our team, I have Alan Frederick, our managing director of corporate finance. When he gets on, I'll let him tell all about his career. I've also got my brother Pat from Citigroup Capital, many years, lifelong finance person in the finance business, and Logan Wood. He'll introduce himself when he gets on. So with that, I guess I'll start with Pat, because I don't know if Alan's on yet. Go ahead, Pat.
Yeah, this is Patrick Flick. I joined Danny Group after I retired from Citi in April of 2019. I was in Asia from 2000 to 2009 with Citi Global Capital Markets. I worked all across Asia, excluding Indonesia. I came back in September of 2009 for Citi New York, Citi Capital Markets, and joined the Citi Holdings, which was the bad bank within the good bank that was put together under the auspices of the Federal Reserve and the Treasury Department. We had 700 billion of assets in what they called the ring fence. And in 2009, and in December of 2009, the ring fence terminated, and then the Holdings was left with about 400 billion in assets. And I worked on my book and other books, and other assets and other investments that Citi held and owned across the globe, from the US to Russia to China to, well, like, no need to go through all the countries. But anyway, I've been doing this forever, seems like, and that's kind of my story. Be glad to go into details if anyone wants, but I don't think this is appropriate for the call right now.
Okay. Is Alan on?
Not yet.
Okay. Well, I'm going to tell you a little bit about Alan. This is Dan again. Alan Frederick came to us in January. He was the chairman and founder for Republic Financial Corporation out of New Orleans. And prior to that, he was the founder of Gulf States Financial Corp out of Houston. And so he's founded two substantial finance companies, and he's been the president of two large banks in his career. And now he's working with us to help companies get through these times, helping them with their restructuring, their refinancing, and anything associated with the capital stack. And hopefully he's having some technical difficulties. He'll be in to share a couple of his stories in a little bit. And now I'd like to introduce our young managing director of business development, our only petroleum engineer in the business. And Logan, say hello and introduce yourself.
Thanks, Dan. Thank everybody for joining in today. It's nice to see everybody here. It looks like there's a good crowd. As Dan mentioned, my background is in upstream oil and gas. Have a petroleum engineering degree, and I worked everywhere from just being a roughneck in Midland, working on the land rigs, all the way to a company man offshore, working for ExxonMobil. And actually, when I was on the rigs in 2015, I was really working primarily on system and process engineering for a couple major systems they needed help with on the rig, and worked on that. That was a significant project because it was about $3 billion total, and Exxon said about 51 industry first accomplishments during that program. So it was really good to be able to be a part of that. Obviously, oil and gas is extremely cyclical, so I got caught in the 2015-16 downturn. Much like earlier this year, except oil didn't hit 5 cents a barrel and futures were negative. But there's a lot of interesting things that came from that. But once I left oil and gas, I moved into wealth management. I did that for about a year and a half, and then really realized, a lot of these business owners don't have access to capital and don't really know where to go. And that's how I had met Dan. And today, I really lead a lot of our efforts regarding working with capital sources, talking about how their market is shifting, really what they are looking for and what they can get done, not what they say they took a look at. And so that's how I spend a lot of my time.
Yeah, that's fantastic. So for everyone in the room, this is our panelist of experts, and I can, from a growth CFO standpoint with clients, immediately after PPP, we're starting to see clients that have bank loans. We're starting to see the banks tighten things up and really get on top of their covenants. We haven't seen the banks pull anybody, as far as putting them into a workout where they have to get out of the loan and get into something else. But we know it's coming. I mean, we'll talk about how the 2008 recession, it could give us some indication of what to expect now. So these are our panel of experts for the event here, and it's really helpful seeing what you all are doing. Kind of where you are. Even see Austin, Texas, Jamel. That's fantastic. So even to get clear on who's in the room, we're going to put up 2 poll questions that you can see on the screen, and we're going to ask you to respond to each question so that we can target our discussion to be more appropriate to be relevant to you. The first question is, what was your top line revenue in the prior year? And the second question, we want to know, how are things changed with COVID? Do you expect your revenue to increase, decrease, or stay about the same? So your responses are anonymous, right? I'm going to share statistically, the numbers in the room, but it's going to be anonymous. We're not going to release anybody's name. So, your prior year revenue and what do you expect with COVID? And if we got 45% of folks responded, if we can get to 70%, it'd be fantastic. That'll give us almost the 80-20 on who's in the room. We got a good nationwide Salt Lake City. We got Paul from Boston, Lynn from Salt Lake City. And as we go through this, as the panelists are sharing with you their perspective, answering questions, by all means, enter your questions into the chat box. I'm going to monitor that, and I'll bring your questions to the panelists so that we can get a real-time answer, real-time insight. So we're at 60%. If we get a few more people to respond, let's at least get to 60%. I'm a numbers guy. I like to see the scoreboard light up and for us to do well. But 70% would be great. But we can live. Yeah, we got to 60. Okay. I'm going to keep it open just a moment longer. So if you want to get registered, get your vote counted, by all means, jump in now before I close the polls. Okay, countdown. Okay, fantastic. So let's take a look. I'm going to end the polls, share the results, and this is where we're at. We're just under 60% are doing 0 to 50. So we got almost, we got over 40% doing 5 million plus. And a couple of larger companies, 40 to 70, 70 million and above. Lots of options there in the debt market for different companies. So very good. So this is always interesting to me, where looks like 56% of the folks expect, their revenue to decrease this year, which is no surprise. That's we're in a recession, the economy is shrinking. So I'm glad you're here. We're going to find some options. If nothing else, you're going to get options on how do you get access to capital, how do you refinance, restructure your debt so that you can afford, you have the free cash flow to afford the payments. So very good. Okay, I'm going to stop the poll and we're going to get right into our discussion here. So now it's for the panelists, okay? And a reminder, if you got questions, put them into the chat box. I'm going to bring your questions directly to the panelists. So my first question here is for Logan. Logan, you ready?
I'm ready.
The first one out of the gate, right? So what have the markets been doing during COVID?
Yeah, well, so obviously we do both corporate finance and M&A, and we work throughout the stack. So looking at financial options, whether it's refinance, balance sheet restructuring, acquisition financing, or looking at doing a carve out in the M&A market. There's a few different options, that people have available, but most of my conversations throughout the day really hinge between two options that most operators are familiar with. They see senior debt, where do I go? Okay, well, I have the FDIC banks. Well, what comes with working with the FDIC bank? Well, right now, they're constantly changing their underwriting guidelines. Typically they want your deposits, they want your treasury. I joke, they want everything but your firstborn kid. And there's a lot of positives there. Obviously, they're going to be the lower end on the rate spectrum, and they have the cash. It's there. On the other end of the table, though, you find people that they think, okay, if I can't get money from the bank, where do I go? Okay, well, on the other end of that, you've got, private equity, which generally wants 50% plus a share at the minimum. And most operators may not be ready to sell control yet. So I have this conversation every day between, hey, I see these two bookends on the table, but really I'm just seeing those in black and white, and I don't really see all the gray space in the middle. So I have conversations with all different types of capital sources like this throughout the day, and the general sentiment across the board has been the same. Leverage has been pulled back. Typically across the board, I'm seeing somewhere between half a turn to a turn and a half of leverage decrease. And what I mean by that is typically a bank will do, pre-COVID, you're looking at, 3 turns on senior debt and 4 turns on total debt. Well, today they have really scaled back and are looking more like 2 by 3, 2 turns of senior debt, 3 turns of total. Another capital source that really start opening up about $3 million in cash flow a year is what's called business development companies. And typically they'll extend higher leverage for higher cost, again, on that risk reward portion. But, they've pulled back leverage too. The deals where they would do 3.5 turns of senior and 5 total. Now I'm starting to see them come back and say, well, maybe we'll do 2.5, maybe 3. And so that's not only on the financing markets, but also on the M&A multiples. So sellers always want, the valuation to be higher and buyers always lower. Well, I've seen that come across in valuations as well, where we jokingly say EBITDAC, with a C for coronavirus adjustment. And so it's definitely been represented across the board.
Hey, Logan, can you explain that? Because not everybody has your financial background. Like when you say 2 turns, 3 turns, I mean, can you give us an example of what that means?
Yeah, typically a turn, if someone says 2 turns, it's typically 2 times whatever your cash flow is. Generally, what most of the people in the finance market use is EBITDA, or your net income. And so typically you'll normalize that out, and it would be 2 turns would be 2 times whatever that normalized EBITDA is.
Yeah. So I'm getting some questions from folks out there. Let me know if we just answered the question about turn, but you literally just asked what we just clarified. And to highlight, what's been the change in the COVID world?
Sorry, can you repeat the question?
Yeah, what's been as far as the requirements, what change have you seen in the COVID world?
Yeah, they definitely stepped up requirements. So you pull leverage down, but you also see the flip side of that, where not everybody's doing perfect during COVID, right? There's a lot of interruptions that have came. And for that, you've got, cash flow that's decreased. Well, that's all great and dandy, but what if you're with a bank that has really heavy covenants? We'll get into a little bit more on what those are if you're not familiar, but typically with a bank, if you close, there's going to be covenants where, hey, you can't have more than this amount of leverage. You can't have more than this amount of debt. And so we're starting to really, really see those underwriting guidelines tightening more and more and more. And it will become even more clear as the Q2 reports start coming out from the bank's regulators. They start talking about, hey, you're overexposed here, or, we don't like you anymore. Go find somewhere else to be. So you start seeing a lot of that, and it's not always new companies or new requests. It's existing customer base as well.
Yeah, I appreciate that. And the question, I'm going to bounce around. I got a question from Raymond asking about, there's a new program, the SBA Main Street Lending Program that's out. And I'll share with you, Raymond, first before I put it to the panelists. Your basic question is, what are people seeing? Is we don't. I spoke to a lender on Monday, a large SBA lender, and they don't know anybody who actually has done a Main Street lending program. The reason why it's super favorable to someone like me as a CEO who needs money for my business, but payments are deferred literally out to the 2nd and 3rd year, and the fees aren't there for the bank, and so it's not a kind of instrument that the banks want to get into. So it seems like there's still some shaking out to be done before it becomes a viable program. Anybody on the panel, have you seen anything in regards to the Main Street lending program? Very low interest rate, very favorable term, but we just don't see any of them.
Yeah, that's an interesting point, because you're right, the deal volume for the Main Street program, I don't know a single person who's actually funded a Main Street loan. Now, they have outlined the criteria and identified banks that want to participate, but we're not even through the PPP money at this point. I think there was about 130 billion or so left over out of the second tranche that came in, but you're starting to find more and more people that were impacted by that, where whenever people are on unemployment making $50,000 a year, and you need a PPP loan to rehire those people, and they want to come back making less, it creates a lot of issues on that front. And so I've seen a lot of clients and customers that have both said, I'm not taking a PPP loan because I can't get my workers to come back. That's been a big issue on that end. And a lot of people started moving to the EIDL loans, where they could get, I think it was up to 2 million or so. And now they've started capping that at a lot lower rate. And Dan can address that a little more.
Yes.
Steps in a minute.
Yeah, the EIDL, for anybody that has a business out there, if you haven't applied, do. It's not free money. But it might as well be. It's 3.25% to 3.75% interest. It is a no payment for 12 months. and then it's over 30 years. So right now everybody's getting capped at 150,000, no matter how big you are. And now this, if you're smaller, they'll give you less. But if you're, and what that cap is, there is no guidelines. They're in their underwriting guidelines, especially if you've done the PPP money. You know, they've already got all your records for the EDIL loan. So if you haven't done so, apply, because it's almost like equity. It's such a good deal. So just piece of advice from someone who's been in the trenches with it for the last couple of months.
Oh. Very good. Appreciate that. So let's go on to the next question. And Pat, I would direct this question to you, and then Dan as well. How are regulators affecting the lending environment, and what's changing? And you had a couple of examples that you wanted to talk to.
Yeah, right now the regulators are focused on the big relationships and the concentrations within these FDIC insured banks. And they work through the risk architecture groups within the bank to identify the concentrations. And the big focus now is on the covenants within the various loan agreements covering these relationships. Everyone is now asking for more equity, particularly on deals that were leveraged to start with, primarily on development and on development loans, whether it's manufacturing, real estate, whatever, where the going in equity requirement was not less than 25%. They're now reaching back and making calls to those relationships, asking for additional equity in from the partners or for the other investors. The hedge funds that were funded by the banks on their line funds are now being asked for additional equity. They're capping their lines depending on the type of business they're doing. I reached out to my friends within Risk and Citi, and once the classification on a loan, relationship loan, gets to what in Citi there's a 1 to a 10 rating. 10 is the worst, 1's the best. I've never run across a loan classified as a 1 in my 19 years with Citi. Once it hits a 7 rating to special situations group, and from that point forward, the loans are heavily monitored for the covenants and their progress. I think this is probably true throughout most of the big money center banks, and I'm sure it's true everywhere else. So right now you're seeing a contraction of loans by the big guys. You see loans that are being put over to the special situations group, or whatever you want to call them, not workout groups, but just where they're closely monitored, much closely monitored than just through the relationship manager. And that's going on right now. So it's becoming a lot more detail oriented on how these borrowing entities are looked at. Certainly if you've seen the news, the massive increase in reserves that are being made by most lenders in today's market. And that's reflected in particularly the oil and gas industry, particularly the commercial real estate industry, and other related businesses. And then within the banks, all of the special entities that have been developed, the CDOs, the CLOs, and the derivatives off that are being really closely monitored, because in some instances, the agent's required to make advances. So, no one wants to have to make advances with the prospect of having to eat those advances later on down the line. So it's a much difficult atmosphere on lending right now on the FDIC insured banks. And this is typical. I saw it happen beginning in '07 before the financial crisis. And then I saw it obviously from 2009 till I retired. It loosened up about 2016, but now it's back to where it was, I'd say 2010, 2011.
Okay.
Very, very tough situations.
So in the chat box for the audience out there, we'd be interested if you guys have applied for a loan and you've been turned down, if you're seeing any tightening of the market, add it to the chat box, and I'll bring it to the panelists here. So Dan, do you have anything else to add about regulators? What's going on there? You're on mute, Dan. Hey, Dan, you're gonna have to unmute.
Let me give you a live example of what we're seeing and what the audience can really depend on. Is, and I'll give you an exact example. We closed a management-led buyout financing that closed January 30th. And we got excellent leverage on it. It's a real good company. It's a medical device business. COVID hits. They're in the surgical device business. And with elective surgeries, they were shut down for 2 months. Because basically they stopped letting elective surgeries go, and spinal fusions were considered elective. And so anyway, it was in May, into May. Of course, we're perfect on our credit. The guy's still cash flowing. I mean, we lost a little money. We lost money in April and May, but we're still, by June, we're back up to even Steven with our forecasts. But anyway, the banks come back and say, hey, name's Rob. Rob, do you think you might need to go out and raise some equity? And of course, that upset him a great deal because we just closed the damn loan in January. We went on the hook to buy his partner out, and he's not buying his partner out and taking all the risk, in which to then have to go out and sell part of his business so that he can make the bank happy. You've got to keep your bankers happy, but you don't have to do what they would like. And there is reduce their risk, make sure everything's perfect for them, but it doesn't really matter if it's perfect for you or not. So anyway, that's what we're seeing. Banks like aces, straights, and flushes. They don't like risk. They only make loans because they feel like they have to. So we're back in that trend, as Pat explained to you, on a very large level at the big banks, but everything goes downhill. If it's happening in the city, it'll be down to Main Street here pretty quick. As to the perception of, well, we better tighten up here, we better watch these guys here, we better, and all of a sudden that the economy slows, and by virtue of their actions, and it's happening. So every purchase deal is going to require more equity. Thus, multiples will be down on the purchase side. And I've seen it multiple times in my career, and we're seeing it again.
Well, I might jump in here. I'm on the board of a multinational company that has been in business since 1784.
Short timer.
Yeah. And they have multiple different entities that do business in most of central parts of South America and all through the Caribbean. They have an entity in Southeast Asia, and they finance a lot of their inventory. Well, they do finance their inventory with major bank lenders, and where the advance rate on their inventory used to be 70% advance rate, 75, in some cases 80%. Those advance rates have now been cut down to 50%.
Oh yeah.
So inspired them to go out and try and raise capital through private investors that they've, when you've been in business that long, you've got a lot of people that know about you. And so they've had to reach out and raise additional capital for different divisions within their company. And all because their advance rates have been cut. Like I said, they've been cut, from, in most cases, 70% to 50%. Well, when you're carrying millions of dollars of inventory in your warehouses and, wherever, and all of a sudden, you've been buying product from this corporation and that corporation, and you've been financing 70%. You got a big problem. So they've had to, aggressively manage their inventory, which they're doing and have been doing for quite a while. So it's not just, this company's does a couple of billion a year in total gross revenue, but it's had a severe impact on them. So this whole COVID thing has had a major impact on them through all their divisions. So I've seen results, and I've seen how the banks are treating them. So it's a tough go right now.
Okay, so let's take the next step. The markets are getting tight. We should expect that bankruptcies are going to start to increase going into the fourth quarter, into next year. The cumulative impact of a shrinking economy is going to play out. So this is open to I'll start with Logan, but then open it up to the panel. What different type of what different types of sources the capital are available to businesses like right now? And
yeah, well, I think, going back to my prior point about, most operators seeing in black and white those two bookends. Well, it's great if you've, cleanly fit into each one of those buckets. But, for a bank to be able to want to underwrite you today, you got to have 2 years of trailing profitability. And, they don't want a company that's going down. They want a company that's going up. And it's pretty difficult if you've been severely affected by COVID, right? And, the flip side of that, they may not be ready to sell control. So really looking at some of that gray space in the middle, there's a lot of these very, very niche capital sources that say, I'll give you an example. Some that say, hey, Logan, I don't care what the company is, how big it is. I only want to do a deal if they're an exporter or an importer. That's all I want to do, 50% net export. Well, that's a very niche market and a niche client base that they're looking for. On the other side of that too, you've got lenders that only want to lend on luxury assets. So yachts and boats and jewelry and things like that. Well, there's not too many people that are beating down the door to only lend on those assets. So you have these little pockets in the capital sources that basically have very specific criteria of what they call a fact sheet on what they really like to see. And usually that's a range on cash flow. Usually it's a range on revenue, and then where they want to invest inside of the capital stack. So as I mentioned, you have senior debt and junior debt. There's these things called business development companies that blend those two together. And that's a financing product called unitranche financing. Well, when does that apply? Well, once you get above about 3 million in net income or 3 million in EBITDA, you start having access to those types of capital sources. And those are the groups that they're not going to have the really, really heavy covenants. They're not going to have, some of the other red tape you might deal with in giving a bank your treasury and your deposits and all these other things. So they come into play. You have sources that are also called mezzanine funds, which are typically hybrid facilities. So they usually have some portion in debt, some portion in equity. And depending on what they need, they have, they typically all have a need for what they call a yield or a coupon, which is an annual basically distribution back to them so that they can spread that out to their investors and their LPs. So a lot of times you'll get, groups like that do hybrids that some may be a little heavier on debt, some may be a little more heavy on equity, just depending on what that yield needs to be. So you get a lot of these hybrid facilities. And then now during COVID, we've been having a lot of capital sources reaching out and saying, hey, we are looking for distressed or turnaround situations or we can write a minority equity check, or we can do some sub debt, or maybe a blend of the two. So you have, pure debt that you can get from probably about 4 to 5 main types of capital sources. And then you have the hybrid groups like a BDC or a mezzanine fund, or nowadays you may have heard the term family office. There's a lot of these guys with their own capital now. They sold out of a company. They have, 10 to 50 to 500 million bucks in their fund, quote unquote, where they basically can, invest however they want. So if they want to do a straight debt deal, they can. If they want to do straight equity, they can do that. And if they want to do a hybrid, they can do that too. So you have a lot of those people that start reaching out. And then private equity have actually started changing part of their strategy where, there's so many private equity groups that are very, very similar nowadays, 2 to 10 in EBITDA, no customer concentration, manufacturing, distribution, business services. It's like very, very, very common. So they constantly have to work to differentiate themselves to become more and more relevant to a specific industry or market. And so to that point, we've started seeing people in that space start decreasing their minimum, or, yeah, we were control equity before, but now we're open to doing minority, or, yeah, now we're open to doing some debt. So you start having a lot of these capital sources that are very cognizant of what's going on. And there's a ton of dry powder sitting on the sidelines ready to get into these deals. So there's a lot of different options people are not aware of.
Yeah. So Logan, so for most CEOs of companies of almost many sizes, right? All that's very confusing. How do they work with someone like you to sort out all those options? Because the things you're saying, most CEOs, would have no idea where to start.
Sure.
So how do they figure this out?
Well, the first thing you need to do is make sure your numbers are updated and clean. And that's where Kirk comes into play. But, if your financials are not strong, you're not going to get a deal done. So that's the first part of any deal, is make sure you've got your numbers straightened out and you know what you're working with. And then once you have that data, then we take a look, when we get a new deal in, we'll take a look and say, okay, let's look at your revenue. Let's look at your assets. Let's look at your cash flow, both on the corporate and the personal side. And let's just take a look and see what's viable in the market and see what makes sense. And if there's not a way that we see to get it done, there's probably a few things that we can say, hey, look, if you can get this, and this done, you're going to be in a much better position to be able to qualify for financing that you're looking for. So sometimes you need some cleanup before you go to market, but really the easiest way is once you get your numbers updated, submit it to review. And then basically once you come back, you can start pointing out some of these pockets in the market. Because, for the smaller companies, most people go to the bank and they always want to push you to SBA loans, right? And that's all great, but it caps out at $5 million. Well, what do you do if you need 5 to 10 million and you're not quite big enough for that 3 million in net income? So there's a lot of these pockets in the market that only like doing those kinds of deals. So I'd say probably the best way to do it is just get your financials revised, cleaned up with someone like Kirk or your accountant or a third-party accounting firm or whoever it is. And then once you have that, you can get a lot better visuals on what's viable in all of the market, not just with the FDIC bank.
And just to build on what you're saying, Logan, it really is a marketplace. You have different lenders with different portfolios, different appetites for risk, different industries, and you really want to work with someone like you all that has expertise to, what databases do you go to, what contacts are interested in what each company has. There's a number of questions in the chat box about SBA loans. I would run them in parallel, right? You talk to somebody who has an expertise to help you figure out how to get access to capital and potentially refinance your existing debt so that you have more breathing room. Basically more you can retain more cash to operate your business, and then at the same time run it through the SBA. To answer some of the questions here, yes, for an SBA loan you can use it for acquisitions, and if you can show how the cash, and to your question, if you're launching a new line of business and you're showing how the cash, if your projections of the business going forward are realistic, your use of funds show that you're going to sell and deliver more product, even a new line of business, the SBA 7A loans will support that kind of stuff. The stuff that they won't support, like if you have unpaid taxes, the SBA loan, that's a major red flag for them. They'll basically won't touch you. They'll run away in most cases. So just giving some insight about the SBA loans. And there's some other questions. See if I can pull them out here. I'll put this one to the panel. There's a question about, on the M&A side, can we expect more seller financing, and how much is reasonable in these days? So that's part of the question that Chris presented to us. So any thoughts about what to expect?
Yes, this is Dan. Seller financing is a big deal. It's always is the piece that helps fill the gap when the other financing sources to augment the equity requirements. So there's not a M&A deal that we ever do where there's not some seller financing. And so it all, like right now, we've got a environmental remediation business for sale. It's my estimation that 10 to 15% of that whole deal is going to be carried by the seller. So could be less, won't be more, but it will be required.
Yeah, it's coming up. And so hey, I want to bring this home because we're at the the 1240 mark. So I want to make sure that we have a chance to kind of show capacity here. So I'm going to go back to screen sharing, and to give our audience a better feel for what you guys can actually do. Logan, do you want to take us through the capacity here?
Sure. And am I able to scroll through this, or are you?
I'll click for you.
Okay. Yeah. Well, here's the team. I think we have 3 of us from the call here, and Alan, it really works on a lot of our corporate finance deals. He's wasn't able to make it today, but he was the executive chairman for the Secured Finance Network, sits on the committee chair there, and president of the American Factoring Association. So
Hey, Logan.
For us.
Logan, Alan is on, but no one can hear him. So
okay, well, he's well
anyway.
represented.
Okay.
Yeah, here's the team, and then Kirk, we can go to the next slide. Yeah, this just gives you an overview of our track record and typically what we work on. As you can see, we've financed deals all over the world. Typically, though, we're primarily focused on North America, some in Central America, depending on the deal. And Keith Fearon, our analyst, actually sits in London, and so we have a little bit of exposure over there as well. But to my point earlier, we do both corporate project finance up and down the stack, and then sell side and buy side M&A. And that's very uncommon in the investment banking market, in the lower middle market. I'm talking 5 to 250 million in a transaction size, because many of our competitors are sell side M&A advisors, and it's 5 million EBITDA plus, and they don't really want to do the financing or know how to do it. So it's a big differentiator between us and someone else. So next slide. This is an overview of our criteria, and Kirk, I believe this is going to be available if anybody would like to review it. But typically, our smallest deal we work on is about 5 million in transaction size. We don't have a cap, but I'd say we start getting squeezed out by the big bulge bracket banks around 500 million or so, depending on the size and type of deal. But we do that, and then sell side and buy side M&A will go down to about 2 million in EBITDA and go up from there. If someone's a little too early for us, or a check size is a little too small, or it's not a good fit, we'll help point you in the right direction. We're all about making sure good deals get done, and whether that's through us or somebody else, we just want to make sure y'all are taken care of. So this is an overview of the capacity that we have. And then on the bottom is the turnaround and management consulting for M&A and financing. So if you're not ready for a deal, but you need maybe some hourly work or some small consulting work, that's what that addresses. So next slide. Here's some tombstones of some of the deals that we've financed and been successful with. It's probably a little different than most, because most of this is just a white paper with someone's letterhead on it. We really, we take pride in our clients and really like them. And so here we put a lot of detail in who financed the deal and who the company is and what they do. And I believe on this, it ranges from 10 or 13 million on the low end up to about 160. So some representative deals. Next slide. Okay, next one. Yeah, so the opportunity, I think, as we spoke on the, a little bit earlier to this, we're expecting a large amount of these refinancings and balance sheet restructuring deals, especially now that the Q2 reports are getting out. Probably 30 days after that, they'll start doing the borrowing base reconciliation. So you'll start really seeing the numbers start to fall there. We've already seen the dominoes starting, and that we think that'll really, really start picking up, and you'll start seeing that peak a little later this year. When people really started getting impacted by this and the stimulus money's out. So these are some of the reasons you see for the tightened bank underwriting. I think we talked about most of this on our prior. Next slide. Yeah, and to my point about the financing sources, you really only have three types of ways to raise money: debt, convertible debt, and equity. And everything falls into one of those three buckets, no matter who it is, no matter what the check size is. So some of the types of debt you see there: senior and junior, which most people are familiar with. You have a first and second lien, respectively. Unitranche is just blending senior and junior debt into one facility. Unsecured, usually that fills gaps in deals. You don't typically find a whole deal financed with an unsecured loan. Same thing with revenue-based. That's typically more for tech companies that have monthly or annual recurring revenue, and you can take that, or what they call gap and stretch financing, where you can fill a very small portion of the deal if you're short. And then cash flow-based financing is what I mentioned with the business development companies. They typically start about $3 million in cash flow and up, and if you can get that through a bank as well, but typically they're about $5 million in EBITDA and up. So those are the types of debt. Convertible debt is not as common for what we do, a little bit up market and the lower middle market. And then equity, you've got the different percentages of that. EV is just enterprise value, total enterprise value. And so mezzanine will usually take 5 to 15, maybe a little higher, depending on the size and type of deal. Minority equity, obviously, they don't want to do it for any less than 10. Most kind of push for 20, 30, 40%. And control equity would obviously be, a partial sale, or maybe you need to sell control and just partner with someone who can put operational financial controls in place. And so on the bottom is just a list of some of the most frequent capital sources that are in the market. FDIC banks, most people are familiar with. Non-bank ABL, which is asset-based lending, and factoring, that's really using your receivables, machinery and equipment, inventory, some real estate. BDCs, like I mentioned, they do primarily cash flow financing, about $3 million in cash flow and up. Asset managers, there's a lot of these public asset managers that have started doing private loans because, like I said, they're just chasing yield and some kind of coupon, right? So if they can get that in the public market, great. If they can get in the private market, that's even better. So they do a lot of that. A lot of these family offices, that can be very flexible, and some hedge fund, not as much in the lower end of the market, but that, and then private equity, which wants control. So there's more than that, but those are really the primary categories. And I believe that was the last slide, Kirk.
Yeah, that is, and it goes, just to bring things home, I want to communicate what we do at Foresight CFO. So we basically use the numbers to help CEOs do the things on the screen, win more customers, keep the ones they have access to capital. So the big story. And we do this through growth CFO work and accounting work. So it goes right to what Loman spoke about. We're making sure you have good numbers, and then forecasting forward to make sure that, how much cash do you really need? What are you going to use it for? And then have a mechanism, like a scoreboard, using those monthly financials every month to make sure that we're getting the results that we expect from the funds that we received. And these are the habits of profitability. These are when we do this with CEOs at every stage of the business, you get the results. You have visibility and you get confidence to execute. And we do it from, we go beyond what an individual CFO can do, because, literally, I'm limited by my own 30 years of experience. That when I have a true team of CFOs, where there's 2 or 3 CFOs who are making sure that we never get comfortable, that we never get into that status quo mindset. We're always in 90-day sprints pushing, taking that next step. That's the benefit of a true team of CFOs that can beat an individual CFO any day of the week. And we do it in a way where we stick our necks out, right? There's an investment for growth CFO services, that we're accountable to deliver, increased profitability, accelerate cash, and maximize the value of your business. So for those of you who want to get that first look loan score, we actually use the same database that a lot of banks use to see how much could a company borrow if from traditional banking, if at all, right? And it lets us figure out what fits according, like, from traditional banking to the kind of stuff that Dan and his team can do at Infinity Finance to bring the working capital and the investment capital that CEOs need to build their business. So definitely, I'm going to roll back a little bit here. We are going to send the slides out to to the folks who participated in today's webinar. This is a big topic to cover in 50 minutes, but so if it felt like drinking water from a fire hose, it was. If nothing else, take one action item. If you get one action item from this to reach out to the right party to figure out what could work for your business, then I'm gonna hopefully declare with you that this was time well spent. But we're available. The emails for Dan's team are on the board. We're going to send the slide deck to you, and you'll have my email and contact information in there. So if you want to hop on a call, I invite you to do so, to talk specifically about what you need. So we're right at time. I'm going to respect that, and very much appreciate people doing better, getting out of the COVID economy. Okay.
All right.
All right. Thank you, everybody, very much. We hope that if we can help you in any way, please reach out to us. No questions too dumb.
Yeah. And hey, Dan and your team, thank you so much. Pat, Logan, Alan's on the phone call. Thank you so much for taking the time out to put this together for everyone. Very much appreciate it.
We enjoyed it.
Yeah. I will talk with you soon.